Hi there traders and welcome to Trade the Structure. Now in this short video, what I want to do for you is just walk through how to trade bounces, or more specifically, how I go about trading bounces using price action trading techniques. Okay, so what I'll do is walk through with you the key aspects that I'm looking for when I'm looking for a bounce and how I utilize different time frames, and also how I tie it all in together with my indicators. Now, essentially, I just use a 10 EMA, exponential moving average, and a 20, and occasionally I chuck in a 50 for good measure. Now, I'll also use the MACD for a gauge on momentum. Okay, so what I'll do, I'll give you an example on the Dow of what I'm looking for. You can see it straight on the screen there, and just walk through with you on the actual techniques that I'm using or the price action I'm looking for before I decide whether I'm going to get involved and chuck my money at risk. Before we get started though, it'd be fantastic if you could jump on our YouTube site and subscribe to the channel and leave us a like on the video. If you do like what you hear, there's going to be a lot more content to come, and it'd be great if you can help us promote the channel and help us build that community and get those algos ticking in our favor. Okay, what we've got in front of you is the Dow 30, okay, and I've just marked it up. So this is essentially some prep work of what you'll be looking for. You've marked up your levels, where you want to get involved, okay? So we're using this Dow as an example, and we know that, okay, the general bias is up. We've got the 10 EMAs above the 20, and that's how I generally define my bias. And I'm trying to use the MACD, trying to pick out the right areas to trade with momentum play. So I want to trade when the market's going into expansion, whether it's expanding up or if it's a short trade, whether it's expanding down. But I don't want to get stuck in contraction if I'm buying when the market's up and I'm buying into contraction here, because I don't know how far down it's going to go. Just because I've drawn some pretty lines through here does not mean that the market's going to, do what I ask it or do what I expect and come down to that level and bounce straight back off it. Okay, so I feel that a lot of losing traders, what they start to do, and it's not just, I wouldn't call them losing, but what I would say is they trade the low probability setups. Okay, so when the market's coming down to a level, ideally, this is what we're expecting is going to happen. Now, there's two ways to trade that. You can trade that when it's on the bounce, when it's actually bouncing back up with regards to your price action. Or what a lot of traders do is trade it on the way down. So what they'll do is see this red candle, they'll put in a bid somewhere around here, for example. They might just put in the bid below, and they might have their risk below. Okay, now if this played out, that's fine. Okay, you got lucky. It come in there, activated, and it reversed before you got stopped out. The problem is the market does it time and time again. What it'll do is come down to another level and bounce. Okay, and what that's done in the meantime, you've got it right. Okay, you're on the right side of the action. Your thesis was right. The market did bounce off that level. Problem is it stopped you out in the meantime, and you may have traded a couple of times in there. You may have traded some big quantity, but the problem is if you get on to it later when it is on the rise, you've already had a loss. Okay, and you might just be making back gains. And who's to say that even if you do get in here, it's going to continue up? You might find that it comes down. Okay, you jump in, and then it turns around and we head south. Okay, we do this, and you bought it there. You essentially get stopped out anyway, but you've had one. This does this, and you buy it again. You get stopped out again. So the last thing you want is to start chopping yourself to pieces before you get into the trade. That actually, whether it turns out right or wrong, if it turns out right, you don't want to get chopped out. Okay, once, maybe twice, before you can get on the right side, because then what you're actually doing is just making back the losses as opposed to getting on a winning trade. Ideally, what we're always trying to get into is once it's bounced, we're trying to get into when it does start to bounce, and trying to get into as early as possible when it does bounce. Okay, I don't technically, if this is a 30-minute chart, which it actually is, what I'm looking for is to trade on a lower time frame chart. Okay, once it starts to bounce, I'm trying to use my lower time frame chart to really pinpoint the times when I think it's going to bounce. And by pinpointing, you're actually reducing your risk quite a lot. And you're never, in my opinion, I think it's just a losing prospect. I mean, trading like this when it's coming into a zone, it's a losing prospect, because over time, if you consistently trade like that, it's a low probability trade. Yeah, you can get close to your support, but who's to say it's going to be support? You can, even if it is, and it bounces, you might get stopped out. You don't know that, because when it's coming into a level, you've got absolutely zero place to place your risk. You can place it below, but the price hasn't confirmed that just yet. Just because it's touched it twice, it hasn't confirmed. Yeah, it may work, but what I think is a higher probability setup is using a lower time frame chart to drill down on that price action. Okay, so you might have this one red candle comes into the level, and the next candle is green, and it goes all the way back up. But within that one green candle, if you drop it down to a 5-minute time frame, you might have the perfect high low. Okay, you might have something that plays out like this. Draw that up, where it plays out like this. And ideally, that's what we're looking for. We're looking for that high low on the lower time frame chart where we can get involved. And okay, and we know exactly from that price action where we're going to place our risk. Okay, so what we'll do is we'll drop it down now. I'll just put down to the 5-minute chart, because I think I've explained pretty much what I'm looking for, how we'll be approaching it. And let's just say, let's just take a look at the actual MACD and how that plays out as well. At this stage, the MACD's down, okay? So momentum's actually down. So we don't know whether it's going to start to roll up or not, okay? We're on the right side of the MAs, which I'm always trying to be above for a buy, or at least have the 10 above the 20 and look for my high low for a buy opportunity, and it's just flipping around for a sell, okay? So let's get over to the 5-minute chart and take a look at that. Okay, with the beauty of Harry hindsight, we do know that from our prep, we've got our 2 levels here. We've got our first level where it double tapped on there, or it retest failed on that level. And then we've got a secondary, just potential for an extension level that we've just marked up, okay, that support down through there, which it actually did trade down through. So if you imagine that the market was coming in, like I was discussing on that 30-minute time frame, and you bought it into this first level, okay, you bought into there, you had to stop just below that, and you just got stopped out, okay? Now, if you bought into this second level, and it didn't get down there, then you've missed a trade that actually worked out really well. Okay, so I'm just assuming, you know, those 2 different scenarios. Now we know that it did tap on that second one, so you bought it there, you got stopped out. You might have bought it again, and then put your stop below the second one, and it's been okay, and you've made a profitable trade. Now, like I said, we don't know if that's going to bounce like it did all the way up, and we've got hindsight in our favor here. Now, if it just rolled over from there, you got stopped out twice. Okay, so I think what the better play is, and the better approach to the market, to the price action, is using what I've got here, the 5-minute time frame. Okay, so what we just let the price action play out, because we don't know if it's going to bounce off here or here. All we're waiting to do is find an area or a zone where we can place our risk. We don't really care where it is, but we know we can place our risk. If the market's going to bounce, we're probably going to get a higher low on a lower time frame. When you get the sellers come in, they come in here, okay, it bounces. Up until about this stage, they're still selling. Okay, once they find out that the sellers have just disappeared and buyers start to come in off this level again, then that to me is a clear indication that we're going to get a bit of a bounce, or at least we've got an indication where we know where we can place our risk. And if it does happen to, you know, bounce up here, we get in through the pushback up through the highs, and it does turn around and get straight back out again, then so be it. That's just the nature of the beast, and we got stopped out. Okay, because there's a good chance that it's just going to keep going down, and we've got this bounce lower high, and it keeps blasting through that support. Okay, but what we're always looking for is an area to place our risk. Now, if we go and box that up, you'll see what I'm talking about. So we've got essentially this move in. We weren't getting involved in this the capitulation into support, because we don't know which one it's going to go to. Okay, we've got the first one, it breaks through there, then the second green candle, it touches on that support at around that 31,860 zone and bounces. Okay, we've got our first bounce. On this red candle, we still don't know what's going to happen. We don't know if it's going to turn around and go back down. And we've got another green candle, yep. Then we've got a red candle here. And then what we can see is this little green candle, it flushes through these lows, the previous 3 candles, okay? And then it starts to go back up again. So essentially, at about that stage, I would be pretty happy to know exactly where I could base my risk off. So what you've got there is a bit of a bounce here and a pullback. And if it was going to be weak, it should have kept going. Sellers should have overwhelmed buyers, and it should have just gone straight back down through the support. But as it played out, it didn't do that. It started to bounce again. So what you've got is 2 things. You've got buyers who've been waiting on the sidelines of watching that price action and watching the 5-minute chart, because they're looking at that 30-minute time frame, that 30-minute level for a bounce. Okay, so they're looking at that and studying it. Now, as soon as it starts to break back up again and it breaks through the top side of the box, they're more than likely getting involved. It does that one thing, so it brings in new buyers into the market because they know where they're going to place their risk. But what it also does is anyone that's selling, they might have bought it from here and they're selling down here. It gives them pause. Okay, they're looking at that going, look, this could bounce off that level. I thought it was going to go through. My thesis was it's going to get poleaxed and it's going to go straight through that support. Now, as it plays out, the buyers are starting to buy it and they're starting to lift it. So I'm probably wrong. So I want to bail. So what that does is from short sellers having to get out of the market and they're buying back into the market, and new buyers that are coming in. So that's all that new liquidity of buyers that are coming into the market. They're going to overwhelm those sellers. Okay, so that's the thesis behind it, and that's ideally what we're looking for. And what has it played out? So you can see that actually bounced. You got in on the bounce. Oh, sorry, you got in through the break of that, the top side of that box, and your risk is below. Okay, you've actually got it here again. You could box up that second bounce there, or you can box it up a little bit tighter. So you've got all these different opportunities you can see by just using that price action from the 5-minute chart, where I can minimize my risk. I can get it nice and early on this first bounce. I could potentially add on this second bounce or the third bounce. Okay, you can add through here and you can add again. So you've got either 1 trade on, or you've got 2 or maybe 3. You've built a bit of a position around this zone as we got more confirmation that buyers are stepping in. Okay, so not only that, it's starting to hover around that 10 EMA, okay, and started to keep pushing above the 10, pushing above the 10, pushing above the 10, and that's what we want. And ideally too, what we're seeing is that 5-minute going from that overextended, the MACD overextension to the downside, or it's extended to the downside, and the momentum starting to swing back up again. You can see that with the MACD. Okay, we've got the MACD crossing back above, and it's back above the zero line. So the momentum is starting to swing. So we've got all this confirmation. We've got it with the price action, with the EMAs, and with the MACD, and you've got that thesis that the buyers are starting to come in. You've got the shorts starting to get squeezed out. You've got new buyers starting to come in, and all that liquidity starting to push back up again, and really starting to put pressure on these sellers that come through. Okay, so you can see that the market started to play out quite nicely. It did roll over a bit later on, but that trade there, if you just look at that, say that initial trade, your risk was somewhere around 90 points, and back into the highs, you've got about 240 points worth. Now, if you could hold it through that bounce, you could have held it towards the highs. Maybe you got out somewhere at the break of that higher low. You've got around 260 points on that trade there. Okay, so you can see that how minimizing your risk, the risk reward profile is still very, very nice. And I bet if you're going back and look at that 30-minute chart, if you just traded it from a basic candle structure, you're staying on the 30, you're trading it from that candle structure, your risk reward might be more of a 1-to-1, 1.5-to-1. So you can see that by dropping it down the time frame, using these price action techniques with my MACD and how I would attack it, I've reduced that risk reward dramatically. I've got more of a 2 or 3 or 4-to-1 trade on my hands. Okay, and it makes it a lot more viable when you're trading that. Okay, it is off a risky zone, but we're always trying to trade in those riskier zones because the payouts are a lot bigger, and you could minimize your risk by dropping it down that time frame. Okay, so that's how I would go about trading bounces. So if the market, the way it is at the moment, we could be bouncing off the major support. The markets are stretched into a support zone, or we've seen it on the ASX on Friday. We saw it on the Hang Seng, the Nikkei, and we saw it on the Dow, and the other major indices. We saw a nice little bounce. Now, like I said, we don't know if it's going to be a bounce. So what I'll be doing is dropping it down some time frames. If we're looking at a daily, drop it down to maybe a 30-minute or 15-minute. If we're looking at a 30-minute, maybe drop it down to a 5-minute, and I even drop it down to 1 just for a little bit extra confirmation. Okay, so I think it's a really handy technique, using your MACD and using your EMAs and what you're looking for. And I think it's going to get you in the right zones at a very low risk trade. If you're wrong, you're wrong. So be it. You're going to be wrong anyway if you're trading when it's coming into the zone. All right, but what you're doing is if you don't get these higher lows play out and it starts to roll over, then you've stayed out of a trade which a lot of people would have probably got into. They're just buying into that support zone. So you stayed out, it's rolled over, it's gone straight through support, no harm done, and then you're probably flipping it over and you're starting to look for a short trade when everyone else is starting to chase their tail because they got in on the wrong time. Hope you enjoyed that. Like I said, it'd be great if you can jump onto the YouTube channel, subscribe if you haven't already, and leave us a like on the video and take a look through. There's a lot of information on there. There's a lot of videos on there that hopefully can help you in your trading journey. And take a look at the website, www.tradethestructure.com.